Today, folks, I want to share with you what I think is about to become the everything bubble. I want to abbreviate to some data I talked about on my live stream last night and how that might perpetuate into the market over the next year or two, and how I'm positioning myself to just try and remain somewhat protected against the volatility that's going to probably hit a lot of these technology-focused assets like crypto, like Nvidia, the semiconductor ETFs, as I've, in full transparency, revealed to you my current tax-advantaged accounts and my major investment accounts and what I'm looking to buy, sell, and move around in this coming tax season. And if that is a conversation you appreciate in that full raw transparency, hit that like button. And while you're down there, if you're on a path to financial independence, to perhaps one day retire early, let's do this journey together and hit that subscribe button. But look at the S&P 500's PE multiple. This is something that I've been very intrigued by. As the interest rate cycle hit earnings on companies, we saw a massive correction in this crazy valuation of a 35 times multiple that dipped all the way down to 20, which was much more modest. But now we're heading back into this place where companies and people are chasing speculation over the underlying fundamentals. And unfortunately, perception is reality, and valuations are all fugazi, but eventually they do end up mattering. And it only takes one real bad market cycle to change the perception and fully kind of tank the market as a whole. And I feel like that's the market we're starting to head back toward, is the economy isn't like in that great of a place overall. I mean, the reality of what's been driving stocks up is mostly business to business. Some fundamentals in the job market still remaining somewhat strong in a higher interest rate cycle, but overall, we are not in a booming market like we were just before the pandemic. And even before the pandemic, the market was much more fairly valued at a 20 times multiple. I don't like seeing the S&P set at closer to 30x, which kind of scares me a bit, right? So I just bleed into my portfolio, and then I'll talk about the data that could lead us toward an everything bubble. Now, firstly, in my tax-free savings account, as mentioned, purchased a piece of real estate last year. I'm looking to build this back as quickly as I humanly possibly can, as I have about $170,000 worth of tax-advantaged room. And I love this account, and I'll say this till the day I die. Every Canadian needs to understand this is where you make tax-free income in perpetuity for the rest of your damn life. You need to max these accounts out as soon as humanly possible. Now, I've been maxing out some tech companies and the S&P 500, but I am looking to rebuild back some Canadian positions and continue to build out some of these tech positions. And I'm looking at tech companies, as mentioned, Google, Tesla. I'm even looking at Apple right now, companies that people are starting to crap on. Their perception is that these companies are no longer in a good place. The glory days are now behind them, and I'm arguing that though I could be wrong, I think they're wrong, and I think these brands are too strong. I think the innovations that they've set in place are going to be so powerful in the coming 3 to 5 years that I'd rather buy these than chase the crypto environment, chase the semiconductor environment that I think is largely getting back into bubbly territory. Though keep in mind, I do have exposure to semiconductors through these ETFs, even in my SCHD position. I mean, SCHD holds Broadcom, within my RRSP here, but I like the diversity because I think there is going to be an inevitable correction in those markets, right? And I do have crypto as well, but again, more speculative in nature, and I am not buying these insane tops and these people chasing this market. If it goes forever, great. I'm holding it for the long run. If it corrects in the short term, that's great. I'm holding enough that I'm comfortable losing it. So taking a look though, how I plan on building these accounts back is kind of pulling some money out of the corporate account. My corporation, as mentioned, I'm trying to avoid touching it because there's passive income tax, but after I get through tax season, talk to the accountant, I wouldn't mind, my corporation still owes me a decent chunk of change that I wouldn't mind trying to pull out of this asset here in the S&P, because I do have about 55% of my total portfolio in the S&P. I don't mind taking a little bit out to put that within my TFSA and perhaps diversify a bit more by buying some Canadian companies, because I think broadly, the market value is still sitting in the lower half of the market when it comes to small caps, when it comes to dividend stocks, though a lot of the dividend stocks have recovered. We're seeing that again with the likes of SCHD. But I think if you're truly a value-oriented investor, or you're an investor that's not trying to get caught in the chasing cycle, you need to look for where companies are getting crapped on that have real branding power. You need to be looking at perhaps diversifying into some of the smaller cap realm of things, which we discussed. But for me, like I said, I really want to build out strong brands like these super awesome tech companies and keep diversifying back into some of the Canadian markets just to get a nice spread. So if the market does correct, I have a nice healthy income to continue to support my cost averaging. Now, the data that makes me think we're heading toward somewhat of an everything bubble has a lot to do with the fact that the PE multiples are getting too high, and I'm shocked because this is during a period where interest rates are still elevated and we have not seen a correction in interest rates. And typically in a low interest rate environment, it really propels a more speculative market, because that's when people leverage, when they see these kind of rallies, they're going to leverage into them. They're going to have more options to leverage, as it's going to be a lot cheaper. And we're in a market where there is record levels of money sitting in money market funds, not only from, the broad-based perspective, but from retail money as well. Like retail money market funds are exploding right now, because I told you, people are getting higher rates of return unlike any time over the last decade. If you can lock in 5 or 6%, that's a very stable return against a volatile backdrop market, right? So I'm very worried that when they start cutting the interest rates, people are going to be giving up on these money market funds. And especially when you look at the rallies happening in the market, that might make people think, why am I going to focus on getting a 3 to 4% return now in money market funds when I can get a 10 to 20% return out of the broader markets, or heck, even chase some of these crypto and tech companies, right? And I think if they cut rates and we start seeing that happen, especially with the real estate market, and things start to balloon back up against the backdrop of an economy that isn't actually growing like it once was. And again, when you see a PE multiple expansion without, the revenue and the fundamentals driving a lot of this, it scares me. It kind of puts some fear in my eyes. So I'm looking for companies that I think largely will have great growth potential, that are, the perspective of them have been unrecognized in the coming years, and the brands are just too powerful. And again, that's Google, that's Tesla. Apple's starting to look fairly favorable here. And again, it's hard to buy companies when the entire market is crapping on them. I know it's the hardest thing possible anybody can do, and I don't recommend doing it with a huge percentage of your portfolio. You kind of got to do it with grace, because it doesn't always work out, as we've seen with a lot of companies, especially in the realm of dividend stocks, REITs, 3M. Alibaba is still having a hard time coming back. So you got to be really careful how you go about it. But I think if this everything bubble doesn't correct sooner rather than later, and it keeps propelling the way it's propelling, we could head back to an era in the next year or two that is very, common to what was the .com level of bubble-ish territory. We're really not that far off when you think about it. Again, you take a look at the price to earnings. I mean, during the .com era, we were sitting at only a 39 to 46 times multiple, and we were almost getting there, during the pandemic rush before the interest rate cycle kind of took effect. I don't like trading in a 30 to 40 times multiple when the revenue growth of major companies just aren't going to be able to back it, in my opinion. Now, I could be wrong. That's why I'm always buying. I'm not shorting. I'm not playing options into the future. I'm a very simple guy when it comes to picking these stocks up. I just want to buy them. I just want to hold them for long periods of time, and I'll ride the market volatility as I have in the past, because it's always worked to my favor. I just don't feel like I'm in a comfortable market environment right now, and I think a lot of people should start feeling a little uneasy, and perhaps, just making sure they have a bit of cash in case some big correction does come around the corner. But I don't know what causes it. I don't know when it happens. I'm just sitting here in utter awe of this insanity. But I'll pass that question off to you. I'd love to know what you think in that comment section below.